Using whole life insurance as a retirement income asset can be attractive to a number of people, but it's not a very obvious feature of whole life insurance. So let's dive into the mechanics and understand exactly how you go about turning your whole life cash value into retirement income. Okay, we have in front of us a proposal for whole life insurance that has been designed to optimize cash value, and we're going to use this particular whole life policy to create retirement income for the individual policy holder. The details of the policy are a male, age 35, who's going to put $25,000 per year into the policy. We'll start on page 1 of the ledger, and we can see that we are in year 1. It shows age 36 because at the end of the year, this individual will be 36 years old. Going to pay $25,000 in annual premium, and at the end of the first policy year, we'll have $19,692 in cash value, and we'll have a little over $1 million in death benefit. Not surprisingly, being whole life insurance, we do not have a gain in the policy at the end of the first year. That's very, very common for life insurance policies, but by the time we get to year 6, we will see a total premium outlay of $150,000 and a net cash value of $153,540. At that point, we have a gain in the policy. We're going to make this payment up to age 65. And at that point, we're going to stop making payments into the policy. So at age 65, this individual has paid $750,000 total in premiums and has a $1.662 million in cash value in the policy and a $1.775 million death benefit in the policy. Now, notice year 31, we see a reduction in the death benefit. It goes from 3.7 to 3.3, and there's a reason for that, and it has to do with the fact that we no longer see premiums due on the policy. That is because we have triggered the reduce paid up feature of this particular whole life policy. We have made it contractually paid up from here on out. This policyholder owes no future premium, and the policy cannot lapse due to non-payment of premium because there are no more premiums due. At the same time, this particular policyholder does not have the option to put money into the policy moving forward. Could always pay down a loan balance if he wanted to, but cannot make any additional premiums into this policy by virtue of triggering this feature. And in order to make it paid up, we do lose some death benefit. You see, we lose in the order of $400,000 in death benefit on this policy, but that comes with the understanding that guaranteed forever and always at this point, no more premiums are due. Also notice we have this income column, and starting in this year 31, we see $80,282 in income. That means this policyholder has taken $80,282 out of the policy in this year. You'll also notice that this same figure continues, and we'll go to the next page where it continues all the way up to age 100. We've gone out this far as a projection, assuming that by age 100, this individual will have passed on. So what this shows us is this individual policyholder has contributed $750,000 in premiums. By age 65, has accumulated $1,662,361, and with that generates $80,282 per year in income for the next 35 years. This means that by age 100, this individual will have generated $2,809,870 in income from this whole life policy. Also notice that at age 100, there is a $462,809 death benefit remaining on the policy. So despite taking $2.8 million out of the policy, If this individual dies at age 100, the insurance company will still pay whomever the named beneficiary is $462,809. So the total amount extracted from this policy is $3,272,679. All for paying $750,000 in premium. That's not bad. I want to go through some of the functional aspect of how money comes out of this particular policy, because you'll notice that we have an income column. We also have this loan balance column. And for the first, that's 9 years here, we see zeros on the loan balance side of this. That means that these are all withdrawals. For those of you who know a little bit more about accounting and taxes and life insurance taxability, we are taking advantage here of the FIFO, first in, first out withdrawal rule, meaning that this individual is recovering his cost basis in the policy tax-free before he moves to loans, which start right here at age 75, in order to continue this $80,282 per year distribution that is income tax-free to him. That also means that all of this $2.8 million was income tax-free under current tax code. It also means that this entire $3.2 million benefit, that is income generated plus the leftover death benefit, also comes income tax-free under current tax code. So for a $750,000 total commitment in premiums paid out of pocket, we have a $3.4 almost million benefit, $2.5 million of which is the net gain, which comes entirely non-income taxable to this individual and his beneficiary. This is the mechanics of how this all works. Now, we should note, policy does need to remain in force in order for all of this tax-free nature to exist. So, for example, we couldn't decide at age 100 that this policyholder wants to lapse the policy and take this $110,000 of net cash value that's in the policy. That would create quite a substantial taxable event to him. You wouldn't want to do that. That would be inadvisable for anybody who owns life insurance for this purpose. The other thing that I want to call out to your attention is that the cash value and all of this income business, all of these numbers, these are projections. So that's a euphemism for not guaranteed. The dividend can change, and if it does, that will certainly affect the values here. If the dividend goes down, it'll make these numbers less favorable. If it goes up, it'll make these numbers more favorable. But do understand that whole life insurance does not operate in a vacuum. It improves or declines in attractiveness based on what's going on in the overall economy for fixed interest rate options. So things like bonds, savings accounts, CDs, things of that nature. As interest rates go down, dividend rates on whole life insurance tend to go down. As interest rates go up, dividend interest rates tend to go up. I do also want to note that while this example uses a $25,000 per year premium, I don't want you to assume that this only works if you're putting $25,000 or more into a whole life policy. While it is true that the tax-free nature of whole life insurance tends to be more attractive to people who are somewhat higher income to very higher income due to the progressive tax nature of the U.S. federal income tax, you can get the same benefit out of a whole life policy at a smaller premium. This works at $10,000. It works at $5,000. Your circumstances may be more or less conducive to using whole life insurance for this purpose, and you may receive more or less tax benefit from it depending on where you sit personally with the way you've organized your own finances. But this is the fundamental functionality of whole life insurance. You can put X amount of dollars in, you can take Y amount of dollars out. Traditionally, Y is a larger number than X, and you can do it income tax-free under current tax code. You can find lots more information about this at theinsuranceproblog.com. I invite you to join us there. And until next time, thanks so much for watching.